Hi there. Welcome to The Street here on BNN Bloomberg. I'm Paul Bagnall. Thanks, as always, for being here. Coming up on the show today, it's been a tough week for stock market investors, and it's not getting any better today. We have a veteran portfolio manager standing by to explain why he believes markets will decline further from here. Our featured guest will also tell us what sectors and what stocks he's buying in these rocky markets for clients. And we'll tell you what the latest analyst ratings and price target changes on big name stocks. Now, our top line story. The stock market rally of earlier this summer now seems like ancient history. Markets around the world have plunged badly since November, and declines accelerated this week, with North American indices down between 2% and 4% over the past 5 trading days. The big event this week, of course, was the U.S. Fed's announcement on Wednesday, when it boosted rates and Fed members raised their forecasts of where rates are going. And also, Fed boss Jerome Powell made a point of saying, quote, the chances of a soft landing are likely to diminish. For insight, let's go to our featured guest of the morning. He's Paul Harris of Harris Douglas Asset Management. Paul, great to see you. Thanks a lot for joining us, as always, as our featured guest this morning. Welcome back to the show. In some notes that you've prepared for us, you believe this period of volatility is not over by a long shot, and you see markets heading lower before they head higher.
Great. Well, thank you very much for having me on, Paul. I think, today I think the U.S. two-year Treasury is at 4.2%, which is the highest in 15 years, right? And I think it's just decreasing the appeal of taking on risk, right? And I think the U.S. dollar, which is breaking out and making new highs, is another headwind, not only for liquidity, but for risk appetite. So, broadly speaking, I think these things are headwinds that until those headwinds disappear, I think the stock market will continue to remain on a downward path. Now, saying all that, I mean, it's fallen a lot over the last week, so I think you may get a rally, but I think the rallies are probably you want to sell those rallies. And I think that the other issue I think that's very important is that we're going through a period of extended volatility in the stock market, and it may end up going on for several more months. Excuse me. But I think we are in a recession, and a recession is unavoidable. I think we're already in a recession. I think I said this a couple of times on the show before, that we're in a recession already. And I think that how deep and how long that will be is very, very debatable. But I think that the issue is that we're facing, substantially slower growth over the next little while. And central banks around the world are on a path of increasing interest rates. And there's nothing that's not going to stop until they see a break in inflation. And I don't think that, inflation being flat over a month is good enough for them. They really need to see it go down what they think is, at a substantial level. So I think that's, until we see that happening, it's going to be very difficult for the stock market to have a sustainable rally. So I think that what you will see is the stock market, once it bounces, which you may get a bounce over the next little while because it has been a very oversold, but I think that there are rallies that you would probably want to sell.
And one of the headlines that's out there today, in keeping with the theme of central banks raising rates, is traders now pricing in a 100 basis point increase from the Bank of England in November. The Bank of England moved up by half a percentage point, 50 basis points earlier this week, yesterday, I believe, and traders again pricing in a full percentage move higher by the Bank of England in November. What would it take, Paul, for markets to turn upward? What kind of economic signals and over what stretch of time do you think would be necessary?
Right. So the first thing is, I think that one of the problems I have with what the central bank does, which is, they run policy, and monetary policy is a big lag, but I think they need to be more aggressive than less aggressive, right? So I think, when we went through 2020 in March, they were very aggressive in pushing down rates and flooding the system with liquidity. On the way up, it becomes much more difficult for them to do that, but that's what they really have to do. So because if you front-end load all those things, monetary policy takes a while to happen effectively. So I think that that's what they needed to do. So the Bank of England and all these things probably need to be more aggressive with rates. I think you really need a slower growth in show some slower growth in the economy and inflation actually coming down. I think one of the problems with the stock market specifically is that when you look at earnings for this year and next year, and this is on the S&P 500, The problem is earnings have not gone down a lot, right? So I think they were estimated to be going up about 8% next year, and they really just have come down marginally. So if we are going to appear to slower growth, I would argue that those numbers have to come down a lot more. And I think you just haven't seen them come down from a consensus basis. I mean, I think some strategists have brought their numbers down, but on a consensus basis, they haven't come down a lot. And I think that, so the implication of that is the stock market, it looks like it's trading at 15 times earnings next year, or let's say 16 times earnings, but it may be actually trading at 18 times earnings if the numbers are lower. And I think that's what you have to look for. So I think you have to look for earnings numbers to come back down, that there's a downturn a sustained downturn in inflation. And I think then the Federal Reserve will probably be a little bit more, will not be as aggressive on rate increases. And I think that's when you want to look to buy the stock market. So I think that's when you want to think about looking. I mean, you should be looking at companies right now because you can get them at good valuations. But I think that's when you can see a sustained rally in the stock market.